Yo, yo, yo.
Yeah.
My boy said
Oh, that logo sure up good now.
it looked better, but it's still like a little pixelated on my end.
It's all good though.
But all right, y'all, welcome back, man. This is Keep It Thorough Thursdays. We back with episode 2. I'm gonna let you go and take over with that said with that intro.
Oh yeah, for sure. Keep it thorough Thursdays. Some of the realest convos and connections that you'll hear. Me and Eric, we've been chopping it up for some years now, and wanted to take the opportunity to bring some of the conversations to Instagram Live. So keep it thorough. Thorough is self-explanatory. Keeping it real, keeping it honest, and all those things in between. And so today, week 2, episode 2, and today's topic is going to be when money matters most, credit edition. And so we got some great content that's in store for you.
So let me touch on that just real quick.
Go for it, bro.
So, like said, when money matters. So we actually gonna do a segment probably once a week, every month, like a money matters segment where we'll touch on different things related to money. Like, so this particular episode is going to be about credit. And then, we'll do one about maybe crypto or maybe investing in the stock market, or just ways to save, manage money and things like that. So you're going to see a lot of different when money matters segments. So I just wanted to add that.
Oh, yeah. You say crypto, investing, budgeting, a lot of other additional things too. So be on the lookout for that. Like he said, once every month. Definitely going to more details on that in the weeks to come. Real quick reminder, as we stated last week, every week after every segment in our bio, we'll have a content kit. And that content kit is just going to give you some of the highlights, some additional resources that are related to the content that we'll be going over. So after this segment is over, go to the link in the bio, see some of the resources and the content that we have in there. It'll definitely be beneficial for you, and something that you can just kind of look through and understand more of as you go throughout the week.
Yeah, just kind of give you a little bit more detailed information, some references and resources with a little bit more detailed information about what we was talking about. So you'll find some for credit in this segment. So without further ado, let's go and get into it, Sid.
Yeah, man.
So when we talk about credit, right, like, I think the best way to really talk about it is, from like personal experience, like things we've been through. So like, what's your introduction to credit, or how you learn?
Crazy thing for me. I probably didn't get my first credit card to maybe 26 or 27. Crazy. So growing up for me, credit was one of those things where it was like, the something bad, it was like, you know what, stay away from credit, or if you get credit, you got to do this, that, and the other. So it's one of those situations where I was like, credit. Do I want to get credit? Do I not want to get credit?
Which it was similar for me to a certain extent, like that, it being bad. Like a lot of the older heads, men in particular, they were always like cash, right? So pay for everything in cash. Like, don't get none on credit. Like, credit's bad. Like, it's a way for them to get you. Like, this just crazy stigma, associated with credit. So I feel you on that.
Yeah. So like you said, crazy stigma. So for me, it was just like, all right, now I don't want to do nothing with credit. But like you said, man, it was just cash. If I couldn't afford it, I didn't get it. If I could, I would get it. So I was like, man, let me stay away from that. But fast forward years later. One of the things that I did learn when I got my first credit card, managing it, and understanding how credit really works, the ins and the outs of credit, the bureaus, the credit score, all the things in between. So, as you get older, you learn certain things, just through research and whatnot, but got more informative with credit. And now a lot of the details that I didn't know then, I'm privy of now. So
which is some of that we're gonna share with them. So just to give my little backstory, my little personal story with credit. So I didn't wait as long as you did, right? I got my first credit card as soon as I turned 18. I was geeked, I'm saying? I'm like, look, I'm finna get this credit card. Now I
Master
did,
that boy out.
hey, right. But now when I first got it, I did go into it with good intentions, though. You know what I mean? I think my first credit card was with, I think it was Wells Fargo, and I think I maybe got like a $500 limit or something like that. Um, but at first, I would like get the card. I would spend money on it, and then I would pay it off. But what ended up happening is I was 18, got into a little bind, ran through that 500 real quick, and I was like, man, fuck this credit card, F this credit card. You know what I mean? Like I'm not worried about that. Like I don't care about credit. Like, I thought it was just I just wasn't too worried about it. So anyway, fast forward, when I moved to Houston, it's been like 11 years. So I was like, what, 22? Something like that. I was like 22 when I moved to Houston, and I was working with an individual who owned a credit repair company. And he basically was telling me, about utilization, being under 30% utilization, kind of put me on game with like statement balances versus due dates and just different things. And he told me about like a secure credit card, which I wasn't privy to, you know what I mean? Where you front the money, but then they still report it like an unsecured credit card. So that's when I really started paying attention again. And at that point, I had some things in collections, but I wasn't really doing anything to hurt my credit, but I wasn't doing anything to help my credit. And honestly, I think a lot of people were in similar situations like that. Like they may not have bad credit per se, but to a lender, bad credit and no credit is very similar. Like if your credit score is low, your credit score is low, period. You know what I mean? But anyway, that's kind of like my little personal story and how I get started. So let's kind of get into the, the nitty gritty of it all, right? So like you had spoke about learning about the bureaus, right? Like the 3 bureaus. So go on, let's lace anybody up who may not be familiar or know a lot of information on that.
Right. So obviously with the 3 bureaus, you got TransUnion, you got Experian, you got Equifax. And then basically with those 3 bureaus, they're the ones that decide your credit worthiness. Are you worthy of getting this money, this offer, these terms? I kind of related to somewhat like a refer a friend program, so if you're a good friend and you've done all the things that you were supposed to do to show that you're a good friend and you're trustworthy, it's likely that you'll get the perks and the benefits. But if you're the bad friend, it's more likely that you'll get the bad terms, rejection, the bad offers, things like that. So just really for me, it was mainly with credit and with the bureau, just kind of simplifying it from terms of, what exactly do I need to do to stay on their good side?
Exactly.
Right? Like,
and what I think a lot of people don't, it surprises me when I talk to people about credit and how many people don't even know, they're not even familiar with the 3 credit bureaus. Or there's like a misconception, like you got a credit score, like it's just one thing, you know what I mean? Like they don't really fully understand not only the 3 bureaus, but the credit scoring models, which we're about to get into a second, and really how all of that kind of comes together to be that worthy friend, as you use in your analogy. Something that I always explain to people when I talk about credit is the analogy I use is, say I got 2 friends, right? For simplification, I'm gonna say friend A and friend B.
Mm-hmm.
So say I borrow money to friend A and friend B. We just gonna say $100. And then say the agreement with both of them is they're gonna pay me back in the 15th of the following month. So we'll just say January 15th. So now we get to January 15th, or we get to January 14th, and friend A didn't already pay me back my $100. They gave me back the $100 I borrowed them. So cool, good deal. Pay me back before the agreement. Now friend B, on the other hand, we get to the 15th, and they say, hey, I got $50 for you. And I can give you the other $50, you know what I mean, in another couple weeks, right?
IOU.
Right, the IOU, right? So now, if these 2 friends were to come back to me, a month from now and ask me to borrow money again, who do you think I'm more likely to borrow money to? You know what I'm saying? Like friend A for sure, right? Because friend A paid me before they said they was gonna pay me back, and I know they're good for it. And if they ask me for a little more, I might even borrow them a little more because I know they're reliable. You know what I'm saying? And like that's the analogy I use when I explain like borrowing money or credit to people who really don't understand the concept. Because like a lot of people are like, well, yeah, man, I got a credit card, I carry this balance, but like I pay my minimum balance every month. It's like, yeah, you pay your minimum balance, but your credit utilization is high. You're not a good friend. They don't know when they're gonna get their money back. So you know what I mean? So it's kind of, you know, that's the analogy I use. But yeah, did you had anything else you want to touch on with the three bureaus, or should I get into the
really, so honestly, when it came to the bureaus, but also I know we're going to go into the credit score. When it came to the credit score, understanding the Vantage score, and then also with your FICO, obviously the FICO is the one that's generally used. But it was interesting to me as like I said, got more familiar with credit, just the different scoring models that are used, and then the bits of information that each one of them takes, whether it be, you know, getting money from a lender for a car or a mortgage or all these other different things that entail when it comes to that. But the underlying thing, like I said, that really kind of resonated with me, it was just the management part. You know, understanding that if I just do the basics, whether it was to the Vantage score or whether it was to my my FICO score, just manage it properly. You know, understanding the different percentages and what they look at, understanding the type of behaviors that are necessary in order to maintain my score. But obviously, you know, through conversations with you and understanding credit a little bit more from the standpoint of different strategies, implementing those, my credit score started to.
And we gonna get more into them percentages that you're talking about too, because I'm sure a lot of people, you know, specifics are really important, right? So we're gonna get into some real specifics about really that recipe, right? Because what I think a lot of the times is people look at credit and it can be extremely complicated, but it don't need to be that complicated, because which I'm gonna go straight into the credit scoring models, right? Which you spoke about the FICO score and Vantage score. A lot of people use Credit Karma. Right. That's probably like the number one go-to for a lot of people because it's free, right? What a lot of people don't realize, though, is that Credit Karma uses your Vantage score. Mm-hmm. Well, 90% of lenders use your FICO score. And the way you calculate your score based off of these scoring models is different. Like, for instance, FICO has 5 different metrics that they use, and Vantage score has 6 different metrics that they use, and then they put different weight on those different metrics. Like one puts more weight on your late payment history as opposed to the other, and typically your Vantage score is a lot higher than your FICO score. And like I have a friend of mine who does I'll just drop his name, Pierre, who does real estate. And like he talks about all the time, like he posted where he's like, people be like, oh, I know what my score is. I know what my score is. It's this. Like, so, and then they go to the bank, you know, all cocky and confident, thinking they know what their score is. And they're like, your score is 100. Your FICO score, which they actually using to qualify you for the mortgage, is 150 points less than your, you know what I mean? I said that wrong. Your Vantage score is 150 points more than your FICO score, which is giving you this false confidence. You know what I mean? You thinking your score is this and it's not. But anyway, so there's and mind you, there's a whole lot of different credit scoring models out there. But the two most commonly used is FICO and Vantage. And FICO is the one that I always focus on. And that's what most of this information in this segment is going to be on. Because if your FICO score is good, all of your other credit scores
just falls in place.
Period. You know what I mean? So so just to give an example, right? And this is just a quick example. So like for your FICO score, if your score is between 670 and 739, that's considered good with FICO. But if your score is between 601 and 660 with Vantage, that's considered good. So you see, that's like a pretty steep differential. You know what I mean? Like that's almost like a 70-point difference between what one is saying good and what the other one is saying is good. So that's kind of just a quick example.
And a lot of those differences in scoring models too determines the terms, the offers, the certain interests that you'll get.
Well, yeah, what your credit score is. Exactly. Right, so whatever your credit score is going to determine. So to go back to my earlier analogy about the friend, right? Like the friend who didn't pay me back when they said they was, and is carrying a balance, so to speak. And technically they're carrying a 50% balance, right? Because they only gave me 50% of the money I borrowed them. That friend is going to be considered more risky. Therefore, their score would be lower. You know what I mean? Versus the one who paid me back. They got good payment history. They on time. Their credit score is going to be higher, which, you know, in the world of lenders, the person who paid friend A is going to have a better interest rate than friend B. If friend B even gets approved, because if your credit score is too low, you won't even get approved for certain things.
Yeah.
But now, so let's go into the specifics now. Now, mind you, these percentages that we're giving you, these are facts. You can go look them up. They're in the link in the bio, and these percentages are based on your FICO score. This is that FICO credit scoring model. This is what they use to create your score. So the most important thing with the FICO score, 35% of your score is based on your payment history. Now, I can't stress that enough, because one late payment from any of your credit cards, your mortgage, your car note, your student loans, anything that you have credit related, one late payment can significantly drop your credit score. And it's not something you can just fix, because it's not going to drop off for a long time, like a long time. So 35% of your credit score is based on your payment history. So now, what can you do to ensure that you paying your bills on time?
Reminders. Put it in your phone.
Exactly.
Put an alarm in your phone. Write it on the calendar. Put it on the sticky note, and put it on your mirror. Because like you said, man, that 35% is heavy. And if you miss one payment, and then obviously, if you get consecutive, this goes back to, like I said, habits.
Well, on your credit reports, you see they give you a breakdown, even on I believe on Credit Karma too, where it'll show late payments in the last 30 days, late payments in the last, I think, 30 to 60 days, and then late payments 90 days plus. So, you know what I mean? They break it down. Now, granted, the further you get away from that late payment, the better it is for you. But if it's on your record, it's on your record, and it's bad. It's going to negatively affect you. But so 35%, right? And then just gave you ways to ensure you paying on time. Set a reminder, write it down. Literally, you can go into your phone every month. And I typically recommend a day or two before your bill is due. Not the day is due, because the day is due, a lot of time, if you're in the middle of doing something, you may hit snooze on a reminder or something, you forget. So I typically say do it a day or two before it's due. And then that way you get yourself some little wiggle room, where if you're busy that day and something come up, you may, remind yourself, like, oh, damn, I got to, But anyway, 35% of your FICO score is based on your payment history. The second big percentage is based on your utilization, or what they say, credit to debt ratio. So your credit to debt. So that's basically, and I'm going to simplify this as much as possible. If you have a credit card, somebody asked a question about, not go over. I'll explain that in 1 second. And that question that you just asked has to do with your credit utilization. I'll explain that right now. So say you got one credit card. That credit card has $100 spending limit, right? Yeah. So if you use $50 of that, and when your statement date comes up, your statement date is what's reported to the credit bureaus, not how much you paid on your due date. Now let me repeat that so that's clear. Every credit card or mortgage or credit bill, whatever it is, car payment, has a statement date, okay? And that statement date typically is a statement end date, and your statement typically is 30 days, right? So from like maybe the 15th of one month to the 14th of the next month, and then it restarts. At the end of your statement date, whatever you owe, that's what's reported to the credit bureaus. So if, say, your due date is on the 8th, but your statement end date is on the 15th, what a lot of people think is if they pay their bill or they pay the minimum balance, then they're good. Which, to a certain extent, yeah, that helps you with your payment history. But with your actual utilization, if you pay your bill on the 8th and then you use that card again up until the 15th, and now that $100 balance or $100 credit that you have available, and there's $50 only that you have available, you're using 50% of your credit utilization, and that's bad. Now, this is the thing that you need to know. You want to use less than 30% of your available credit across all of your credit card accounts. And the reason that you want to do that is because lenders do not want to borrow money to people who need it. They look at that as risky, because they don't know if you get into a bind, you're going to run through your credit, and then they don't know when they're going to get their money back. They
Yeah.
like to lend money to people who don't need it. You know what I mean? So that's why it's really important. And if you're really good at managing your credit, you want to be below 5% utilization. I say 3 to 5. I typically aim to be at below 5% utilization. That's what I aim at. But the golden rule, or the rule for most people, is to be under 30%
30%.
utilization. Now, again, I can't stress enough the importance of your statement date.
Yeah.
You need to know your state. Obviously, you need to know your due date because you need to pay your bill on time. But you need to know your statement end date. You need to make sure that by that statement end date, all of your credit balances are below 30%. Because when that statement date closes, that amount that you owe is what's reported to the credit bureaus. So cool. And then we're going to go into the next one. So 15% of your score is based on your length of history, which you can explain that shit. Like, it's pretty self-explanatory, but you can explain.
Yeah, simplified is just the longest tenured credit card that you have, and basically maintaining. I know a lot of people, in some instances, may have a card that they don't typically use, but it has the longest credit history associated with that.
Yeah, and it's actually an average. It's not just the longest one; it's an average. So, say you got one card that's 14 years old, and then you got another one that's 7, it's going to average that to a 7-year credit length of history. Like it averages it out. So it's not necessarily, it's an average. It's an average.
Yeah. And then, so that's what, the 15%. And then what was the next one? The 10%.
So the next one, so 10%. So 10%. Oh, wait, I want to go back to that length of history. So this is like a cheat code for credit. But it's risky. So if you know somebody who has really good credit, and you're trying to build your credit, something that you can do to help your credit, your length of history, is being added as an authorized user to an account.
Right.
Because basically what happens is, so say somebody's had a card for 20 years and you just started building your credit. That 20 years is going to help your length of history, and you essentially benefit from their on-time payment history. Now, the reason I say it's risky is it's risky for both parties. It's risky for the person with the good credit, because if they add you to their account and they give you a card, and you go out spending and run up their credit, that's risk for them. But you don't have to give that person the card either, though, so that you can minimize that risk. But then it's risky for the other person who's trying to build their credit, because for whatever reason, if that person gets into a bind or something happens and they don't take care of that card anymore, it's gonna fall on your credit too. So make sure you do it with some trustworthy people. But that's a kind of like a credit hack, like a cheat code, adding somebody as an authorized user. But then, so the next one that was speaking to was 10% of your score is based on credit inquiries, right? So whenever you apply for credit, that's an inquiry. You know what I mean? So like if you go apply for a car, or you apply for a mortgage, or you apply for, just a credit card or a Macy's card or whatever, whenever you apply for credit, that's an inquiry. Now, in the grand scheme of things, if you have really good credit, a lot of credit inquiries really won't hurt you. But if your credit isn't that good, this can hurt you, because if your score is already low and it's deducting points every time you have a new inquiry, that's negative. Now there's some exceptions to your inquiries, like if you're shopping for a mortgage, you can do a whole bunch of inquiries in a short amount of time. So like I think it's 60 to 90 days. Any of the inquiries that are done within that time frame will just count as one, and it doesn't negatively affect you. So there's some, or if you apply for certain credit cards with one lender. So if you apply for, say, Chase credit cards, and you apply for multiple of their credit cards on the same day, like it'll just count as one inquiry because they've already pulled your credit. But so 10%. Anything else you want to allude to on that one? Said?
No, that was really with the 10%. That was just a basic one. And just to kind of piggyback on all the information that we're sharing, one of the common things or themes rather, as it relates to credit, and I just want to kind of keep emphasizing this, on being a good manager of how you oversee your credit. You know, and understanding as we're just going through these strategies, the good manager, just like in the real world, if you're working for a business, the good manager typically gets the perks, gets the promotions, gets the high praise. Everybody likes the good manager, right? The bad manager typically gets the demotions, or they stay stagnant, or they got to work themselves back up to building to the status of a good manager. So just basically understanding that, you know, when it comes to managing your credit, there's just specific things that you just have to do to maintain a good score.
And these 5, which we didn't hit the 5th one yet, which I'll do in a second. These are the 5 things you need to do. You don't really got to get too involved in what's a Vantage score, what's a FICO, what's, you know what I mean? Because like I said, it can get very complicated. Because even within the FICO, there's multiple different FICO scores. You got like a FICO 9, which is the most used. You got like a FICO 8. You got a FICO. There's like FICO 9 auto scores for auto loans, and it just can get real complicated. And you really do not need to know any of that. If you're following these 5 things right here, and consistently doing them, your credit score is going to be good, and you're going to raise your credit score. And then I just want to touch. Go ahead, say my bad.
No, I said consistency is key.
Exactly. And then now the 5th, which is also the last 10%, is based on your types of credit. Now, there's 3 main types of credit. You got revolving credit, which is basically like credit cards. So whenever you get a credit card, they basically give you a certain amount that you can spend. And then, you know, you pay that off. And then you can, as you pay that off, that limit goes back to what it was, and you can continue spending. That's a revolving card or revolving credit. And then you have a charge card. Charge cards aren't as widely known. A lot of people are familiar with the American Express Centurion card, aka the black card. That's an example of a charge card. You got to pay that off in full every month. You can't carry that. You can't carry the balance. So it's very similar to a credit card, but the difference is you can't carry a balance. You got to pay it off every month. I don't know too many people who have charge cards. Now the third, which is very popular, is installment credit, like installment loans. So those are your mortgages, your car loans. That's where, you know, there's a set amount of money that you borrowed, and then you just pay that every month. You know what I mean? It doesn't go back up, or you can't use more of it as you pay for it, like a revolving credit card account, but you just pay off what you initially agreed to, and it's just a revolving or an installment loan where you just pay it down. Now, the reason the lenders want to see a mix, and the reason this is important in the credit scoring models, is because they want to know that you're responsible with the different types of credit. You know what I mean? That shows that, you know, regardless of the type of loan or the type of credit you're dealing with, that you're responsible. Now, granted, it's only 10%, which is a smaller percentage, just like the credit inquiries, but it's still important. Somebody just asked a question. When you can, thoughts on these credit repair programs or businesses? This is my personal thought, and I'll let Sid talk on this too. I think it's important to take responsibility for your credit. And I think a lot of people use those services because they're not knowledgeable on credit, and they don't know where to start, really. So their credit is just messed up, and they're just reaching out to somebody for some help. Me personally, I've never used a credit repair service. I fix my credit by myself. People who are in my family or close to me, friends and family, I typically give them tips and can help them. One thing about the credit repair businesses that I do see some benefit in is they're sometimes pretty good at getting things removed from your credit. Yeah. So if you have something that has went to collections, and maybe you got, because some things fall off in like 7 years, I believe it is. I need to fact check myself on that. I think it's 7 years. But if you are at the beginning of that 7 years and like you're trying to build your credit and it's just going to be sitting there, sometimes they're good at getting stuff removed. But if you don't really have a lot of things in collections and it's just a matter if you're just trying to build up your credit, I don't really think you need a credit repair service. Like, you just need to follow these 5 things that we're telling you and be consistent with it, and you're good to go. You're really just paying somebody to tell you what we telling you, or somebody paying you to go find information that you can go find for free. You know what I mean? So
Right.
that's my now. I'm sure a credit repair person is not gonna like that because that's their livelihood.
Nah,
That's what
man,
they
they
do
gonna
to
tell
make
you that
money.
you're wrong.
They gonna tell me I'm dead wrong. I'm sure, but
You
that's
wrong, man. That
my
ain't
view.
what we do.
You know what I
Yeah.
mean? Your thoughts on that? Sid?
No, honestly, bro, and like I was saying earlier, just through the relationship you and I have developed over the years, and then one of the biggest things that you told me was about the statement end date and understanding that aspect of it and paying early and paying a little bit more in some cases too when I can. That definitely, allowed me to see my credit score kind of skyrocket. But then also, like you said, just being consistent on how I go about paying, doing it with the end date, doing the credit mix, and I also seen my credit score go up even with the credit mix,
Yeah,
and diversifying that. You know what I'm saying? So it's almost just like with investing and diversifying your portfolio.
yeah.
So it was useful for me in that regard as well too. So I've never had to use a credit repair program, but go ahead.
So no, I was going. Somebody had asked the question. So you can get stuff removed yourself for sure, and I know people who've done that. Like I told you in my personal credit story, I had some things that was in collections, but I had stuff that went to collections when I was like 18, right? So by the time I started working on my credit again, I was like 23 or so. So a decent amount of time had passed where things were getting ready to fall off of my credit report. So I didn't really need nobody to get them removed for me. Now, again, to go back to the benefit that I said, sometimes they have relationships with people, these credit repair services. They got relationships where they may be a little quicker at getting stuff removed. So if you got a very complex, bad credit situation where you got tons of stuff in collections, and then a credit repair service may be good. But I don't think that's most people's situation. I think most people's situation is they might got one or two things in collections, and they just don't fully understand what to do to build their credit. Like they don't know about the statement end date. So many people don't know about that. Like they just think if they pay they think if
That
they
was
just pay
gold for
their
me, bro.
bill on time every month, that they good. And it's like
Yeah.
more than that. You got to make sure that your utilization is low as well, not just paying on time. It's multiple things.
Right.
But yeah, you to answer that in short, you can get things removed yourself. You're just gonna have to do the research. And there's tons of YouTube is like University of YouTube, baby. You go on there, how to get stuff removed from your credit report. I guarantee you're gonna find 100-some videos that'll walk you through that process. So what was this question? That's what I do. I pay triple of what I owe, but then I get right back. Yeah, exactly. You know what I mean? Pay off. If you overpay, I wouldn't recommend necessarily I wouldn't pay more than you owe necessarily, but hey, it is what it is. But
Whatever works.
whatever works for you. You know what I'm saying? 110%. But and there's some so there's a couple more things I want to touch on right quick. We provided some references and some resources. If you go to our page and click on the link in the bio, it's gonna take you to the credit kit. And if you go to the back, there's a link in there for FICO.com, CreditKarma.com, AnnualCreditReport.com, and then there's to the pointsguy.com where he just breaks down those 5 things that we just told y'all in even a little bit more detail. But what I want to touch on is this. There was a federal government, I don't know if it was a law necessarily, but the federal government made it where you can get access to your credit report for free every year. Now, credit report and your credit score are 2 different things. Your credit score is just that, scores. Your FICO score, your Equifax score, your Experian score, your TransUnion score. Your credit report is what's on your actual credit. So the accounts you have open, whether you paid them on time, your payment history and all that. If you go to annualcreditreport.com, it's annualcreditreport.com. Now, this is a government-backed website. This ain't no fluky BS. Once a year, you can pull your credit report from all 3 bureaus for free. Mm-hmm. And now you don't got to pull all 3 of them at the same time. You can pull one now. You can pull one in February. You can pull one in March. But a year from when you pull it is when you'll have access to that one again the next year. That's very important, too, to know what's on your credit report. I think, to be honest with you, I think my mom is who told me about the annual credit report. And she told me about this like a long time ago, back when I was first building my credit. I think that's where I learned about that. But yeah, and you can go look it up, Google it. You know what I mean? It's federally backed. Like it's legit. And then now my FICO. Anywhere you go when they are giving you free scores, like through your bank, you know, whether you got like Chase, Bank of America, I don't know, some other banks, TCF back in Minnesota, I don't know, wherever you bank, if they're giving you a free score, 9 times out of 10, it's not a FICO score. It's a Vantage score.
Vantage score.
And you can look it up. It'll show in the fine print and the details, all that. It's going to show you what score it is. They have to. If you want your FICO score, 9 times out of 10, you got to pay for it. And myfico.com is where I recommend you go. Now, the only time I pay for it and have a subscription to myfico.com is when I'm getting ready to do something or make a big purchase where I'm like, I am my credit to the T, right? I'm trying to make sure I'm below that 3 to 5% to raise my score as high as possible. And they update your 3 scores once a month, as well as give you your credit report. So all of the information. So that's when I go to my FICO. If I'm not really buying anything big, I don't want to pay, because I don't need to pay to monitor, to look at my scores. If one, I know they're already good, but in two, if I'm not buying them, it's just pointless. Right. Now, if I'm not buying anything, I just use Credit Karma. It's my Vantage score. I've seen my FICO score and compared it to my Vantage score, and I see that there's a difference. So, you know, I'm familiar. But, you know, any glimpse at your credit is good to be somewhat knowledgeable. So I'm not knocking Vantage scores at all. I'm not knocking them at all. I'd rather you know your Vantage score than not know what your credit is.
Yeah.
You know what I mean? But yeah, in summary, is I'm trying to think if there's something that I wanted to hit on that I missed. The point of this segment was really to just go over the general basics of credit. You know what I mean? Because a lot of people I feel don't fully understand it, and they kind of overcomplicate it to a certain extent. It doesn't need to be complicated. The 5 things you need to know are those percentages. And if you're doing what you need to do within those 5 things, your credit's gonna go up. Period. Yeah. It's no guessing game. It's no if, and, or buts about it. Like, you do those 5 things, your credit score is gonna go up. But yeah, man, credit is very important. Can't stress that enough. Credit is king. Don't let nobody tell you cash is king. A lot of people who deal strictly with different cash, and if you don't got a paper trail, sorry, you're not gonna be able to buy certain things because they're not just taking cash. You need to be able to show where the money came from, 1, and 2, credit is better. If you got a lot of cash, you don't want to use your capital. You want to save your capital and you know, use it for investment purposes, not just necessarily buying things. And credit shouldn't be additional income. Don't treat credit like additional income. Credit, if you don't have the money, don't spend a credit card for it. Only use your credit cards for things that you have the money for, so that you can pay it off. I recommend paying your balances off in full every month. Don't carry your balance. You do not need to carry your balance. What you do need to do is show usage. So to go back to that statement end date, if you like buy something and you just pay it off right away and it doesn't show up on your statement, the credit bureaus aren't going to see that you're using the card. It's going to look like it's sitting at zero. So when people say you need to carry your balance, that's BS. You do not need to carry your balance. You just need to show usage. So just don't pay it off before the statement end date. Let the statement end date hit, then pay it off. But pay it off in full every month. But anything you want to add on to that, Sid?
Man, don't be a bad manager and don't be a bad friend. Really just like you said, man, just consistency. Doing the 5 things as it relates to your credit. Stand on top of that, and everything else really.
Yeah, and let's just recap that real quick. So the 5 things: 35% is payment history, 30% is your credit utilization, 15% is your length of history of your credit, 10% is your credit inquiries, and the other 10% is your credit mix. Those are the 5 most important things. You do that, your credit will be good. So we gonna wrap it up. We typically want to keep these segments 20 to 25 minutes or so. This one went a little longer, but again, this is one of those topics, and we had a couple questions that we wanted to answer. So this is one of those topics that require, you know, just like a little bit more information. If we missed something or y'all got a question, feel free to shoot us a message, you know what I mean, a DM, or, you know, comment on some of the posts that you see on our Instagram, and we're more than happy to answer your question. I'm not going to sit here and act like I'm a credit professional. Like I don't do that for my career, but I have managed my credit, my wife's credit, and helped several friends of mine who could vouch for me. And it, you know what I mean? It's not rocket science. You know what I'm saying? It's really not. Don't overthink it. And you know what I mean?
Keep it simple.
Keep it simple. You know what I'm saying? Keep it simple. But without further ado, we'll be back at y'all next Thursday. Obviously Christmas is in a couple days, so you know, I hope all y'all have a Merry Christmas. Spending time with y'all family. Enjoy that time. And I'll let you close it out, Sid. Hey,
That's
keep
it.
Keep it thorough, baby.
Next week, what we got? Strategic planning.
Yeah, strategic planning.
Strategic planning. So mark your calendars. I'm not sure what next Thursday, what the date is.
I can tell you right now. Next Thursday is the 30th.
The 30th.
So we'll be back on that'll be the last episode of this year.
So we definitely want to highlight that one next week as we go into the new year, getting everybody prepared, planning, preparation, getting
ready to build that momentum if you ain't already started.
That's it, man.
You know what I mean,
build that momentum.
Deeper information for planning around building that momentum and ways to get things moving, man. It's all about positive energy, man. Growing, self growth. You know what I mean? Getting your business off the ground if you're trying to do a business. Building your credit if you're trying to get your credit together. You know what I mean? Whatever. That's what we're here, man. We here to provide benefit, to be beneficial, and to just keep it thorough, man. We gonna shoot it to you straight, man. It's real information. We're not gonna lie to you. If we don't know, we're gonna tell you we don't know. But if we do know, we got some tried and proven things, which everything we just told you today is tried and proven and factual information. Just gonna keep it thorough with you, man. But yeah, man. Hey, appreciate you, Sid.
That's it. All the time, brother.
And
appreciate you all tuning in. Join us next week. And as I stated earlier, go to the link in the bio for the credit kit, some additional content, some additional resources, and we'll see you all next week. Be beneficial.
Y'all.
Peace.